Hello, everyone, and welcome to our latest edition of Charting Forward. Charting Forward is our main market outlook opportunity. It's a chance to get together a group of renowned experts focused on the markets and really just having a casual conversation. What do we see as important? What sort of trends and themes and patterns do we think are most meaningful? How are we making sense of the markets in uncertain times? And as I look at the markets here in September 2023, uncertain is certainly an adjective I would use to describe conditions. A lot of question marks. We've had a pullback, an initial pullback at least in August. We've had a nice bit of a recovery here coming out of the Labor Day holiday. The question is, what's next? We're also in the seasonally weakest part of the year here in August into September, but setting up for the fourth quarter, which actually tends to be quite strong for stocks, particularly in a pre-election year. We've got a lot of questions in terms of leadership themes, growth stocks doing well in a high-rate environment, inflation data, new IPOs, so much ground to cover. We're going to do the best that we can, and we have three really fantastic guests to join me here to have this discussion. Tom Bowley, Chief Market Strategist at Earnings Beats. So good to have you back on Charting Forward. How are things in South Carolina, okay?
Hey, South Carolina's been great. Done some traveling this summer, and like you said, I'm getting ready for the fourth quarter. I think fourth quarter will be a strong quarter, so I'm looking forward to the Charting Forward show that we have here and discussing it with some of my friends.
I noticed you're smiling. I was going to imply that that means you're bullish, but you're always smiling, so I don't know if that necessarily is a good indicator. We'll see what you say. Mish Schneider, Chief Strategist at MarketGauge, coming to us from Santa Fe, New Mexico. Mish, great to have you back. You were in our last Charting Forward. How's your summer been, okay?
It's been fantastic. I'm one of the few people that actually love the heat, so I was happy, like a lizard.
I was going to say, this may be the most joyful combination of three guests that we've had on the show. So that's going to be fun. Mish, welcome, and it's good to have you back. Julius de Kempenaer, founder of RRG Research, one of my colleagues here at StockCharts. Julius, I'm always often asking you, how are things in the Netherlands? Now I'm asking you, how's the weather in the next room? Because you're here in our StockCharts headquarters. Welcome to Redmond, Washington. How are you? Are you all right?
I'm fine. Yeah, I arrived day before yesterday, so I've already been able to get used to the weather here for a day, which is actually really nice. It's not that bad, so I'm happy here.
It's a lovely time, not too unreasonable on either side. It's pretty comfortable time of year. Now, comfortable is not necessarily the way that I would describe a lot of investors' mindsets right now. And let's start with just the big picture about where we're at. We've obviously had sort of that initial salvo of uncertainty. We had the pullback in August, a very quick recovery, and now we're sort of in that question mark phase. The S&P is currently just below 4,500, rallying a bit here in the middle of the week, but overall a lot of question marks. Mish, as you're looking at this environment, we've had this drop in August. We're now in September, when a lot of people sort of naturally expect a little weakness in stocks. How much of a further deterioration do you see developing, and why here?
Well, when I hosted the show Final Bar for you, and I had sort of the 20 seconds to think about what was the next direction of the SPX in the next few months, up or down 10%, I actually found myself saying up 10%. And at that point, it was trading a little bit lower, so we're only a few percent higher from there. And the reason why I'm not as bearish as I would think I should be at this point if I use logic and all of the headwinds is because all the risk factors that we like to look at have still basically said risk on. So I'm going to go with a more positive outlook, short of something disastrous happening, assuming that at this point, the market, which of course we know doesn't necessarily always reflect the economy, has absorbed higher interest rates and obviously can see oil and gas going crazy and has absorbed higher inflation expectations, thinking that everything will be short-lived. So yeah, that's kind of how I'm looking at it right now.
It's Tom, interesting. When I'm thinking of you, I was looking at your blog before we started here on StockCharts, well written as always, and I vividly remember last year, I will publicly acknowledge, in June, I remember you talking about a bottoming phase. I remember in October, it turns out being correctly bullish, recognizing some signs of strength. Now we've run quite a bit from those levels, and we've started to pull back, particularly in technology leadership like Microsoft, Apple, and others. Do you still see signs to be bullish now, even after the run that we've had in 2023?
Yeah, I'm still pretty bullish. Back in, I guess it was mid-July, I wrote an article and talked about some of the headwinds that we were going to face for the next couple months. We had gotten to a point, we had some negative divergences that had appeared back in June and into July on some of the major indices. So I thought we were at a point where, and also a lot of the sentiment, the equity only put call ratio, which had gotten so bearish, folks had grown so bearish. Actually, it had flipped, and we went to a 5-day moving average of the equity only put call ratio back in July. That was the lowest we saw in probably about 15 months, 14 or 15 months. So some of the things that I was looking at that had me thinking that we were bottoming in 2022. Some of that's flipped a little bit as we went into the summer months. And I know that the mainstream media always talks about go away in May. But as I've talked about, and I've done research back to 1950 on the S&P 500, and I think it's a mid-July to late September go away period, which I talk about just about every year. So I think we're in the summer doldrums right now. I do think that we've got potentially maybe one more drop. I don't know if we're going back down, but I do think the next week to 10 days with these inflation reports coming up later this week, and then the Fed meeting next week, I think you have a catalyst, perhaps, if something is said or we get a report that's a little out of line, or maybe we go back and retest the recent lows, maybe even just a little bit below. But I'm kind of like Mish. I think we go higher. And I think by the fourth quarter, I would not be surprised if the S&P 500 hits an all-time high in the fourth quarter.
Right. Okay, so certainly pretty constructive here. And it's interesting. You'd mentioned, of course, we should make it clear, there's so many data points coming out just in the next couple of days as we're recording this. We have the latest inflation data coming out this week. We have a new AI-fueled IPO coming out this week. A lot of things that have market-moving potential, but I think that's the reality of investing in 2023. Julius, can I find a bear in the room? Do you see further downside for stocks below what we've seen so far in the drop in August, or are you looking at this as an opportunity to reset for the next leg higher?
Yeah, the latter. It's going to be a little bit boring now because we seem to be thinking alike, all three of us. So, but yeah, I mean, I'm curious. You say that we are. I heard you say like already 2 or 3 times we are starting to see some sort of a correction. But where is that? It has ended. If you look at a daily chart, it's higher highs and higher lows. So where is that correction? We're going up. So I cannot see that as a bearish construction. So I'm on the bullish side. I'm actually watching that 4,600 level in the S&P. That's like an overhead horizontal level. I think is very important. Yeah. If we can take that out, the next stop is the previous high, so it's the all-time high. But just like Tom said, I wouldn't be surprised if we go beyond that in the fourth quarter.
Yeah. It's interesting. I mean, I guess the debate would be the high that we had right around Labor Day, right? Sort of that September peak. Is that sort of bounce off of? Is that dead cat bounce kind of thing before we get the next leg lower? And I will tell you, we've not seen that yet, and that's the reality, right? Names that have pulled back, stocks like Apple and Microsoft, they're not horrible charts, right? I think to your point, Tom. I mean, these are not broken charts, and even the charts that have pulled back don't look horrible. They actually still look pretty constructive. So I don't disagree, Joe. I don't think we're seeing disastrous signs just yet. Now, help us paint the picture of what could change, Mish. You'd mentioned in your sort of initial comments, some of the risk factors that you look at. What would tell you that conditions are starting to, what have you not seen that would become magnified? What conditions do you see the market not reacting to that would tell you things are really starting to get worse?
Well, if we had to stay within the equities zone, I would look at the retail space. That is still somewhat of a concern because it's not doing very much, and it's been really underperforming, particularly if we're looking at large cap leaders, but also even in the S&P 500 and the Dow Jones Industrial. And if we look at it through XRT, as you have a chart up right now, we can see that it hasn't necessarily broke down to critical levels.
Yeah.
But if we're looking at these sort of July resets, and to kind of jump on Tom's point about sell in July, we had written an article about that too, based on our 6-month calendar ranges, because SPY Qs, they all went to their 6-month calendar range high that was set in July and then failed it. but none of them have really broken the 6-month calendar range low. Retail, on the other hand, not only never really got up close to the high again that it made initially in July, but it's broken down under the 6-month calendar range low. So that would be where my eyes would be in terms of the equity space, is what happens with the consumer. And of course, that's going to depend on everything we just talked about. What happens with inflation, what happens with interest rates, what happens with all of the geopolitical stress, how much can the consumer continue to stay in front of the high costs of things without that really bringing everything down. So hopefully we hold around these levels, we get back through, let's say 62, 80, 90, which is that 6-month calendar range low, which case then I would get much more bullish. So right now I'm more in that range bound head, 440 to 450 in the S&P, and let's see what happens if we can get through there, what Granny, who I like to call Granny, does.
Granny retail, right? And you mentioned you mentioned a number of those factors that can weigh on consumers. Higher oil prices, right, is another one. That just travel, things are getting more expensive for consumers, to be sure. Julius, when you're looking at the sector rotation, we've had this sort of change of character a bit where energy has really emerged in a position of strength, which is very different than the first half of the year, which was sort of the growth leadership sectors. When you think about this recovery that seems very clear from your perspective, where is the leadership coming from next, or where do you see opportunity? Is it energy that has started to rally, or things like some of the growthy sectors that have pulled back a little bit here recently?
Yeah, if you look at the rotation of energy, that's certainly on the map. I mean, it's one of the few, well, actually the only sector that's moving into the leading quadrant on a weekly RRG. So that's certainly a sector that is very likely to do good in the next couple of weeks. But what I'm actually watching is the 3 sectors down in the weakening quadrant, and that's consumer discretionary, that is technology, and it is communication services. These sectors have been driving the market higher, and they've gone through a bit of a relative setback. And they're now, it looks as if they're lining up to get back on track, especially when you bring in the daily version of these tails, then you will see that they are all now heading towards the leading quadrant. Tech is already in there. You see communication services almost like in the crossing through the center into that leading quadrant at a strong heading. And you got consumer discretionary, which is comfortably inside the leading quadrant, losing a bit of momentum, but really underscoring the strength of that sector. And those 3 together, these sectors are making up 47% of the market capitalization. So when they do well, it's very likely that the market will be doing well, especially if we can see some outliers from the smaller sectors. But I mean, almost 50% of the market doing well and outperforming the market, because that's what we're looking at on RRG, I think is pretty bullish for the market as a whole.
Yeah, someone just on my show recently, and I forget the exact comparison, but it was something like, it was telling me all the other sectors that are the same weight as Apple. Right? Apple equals all these other sectors combined in the weight of the S&P. That's really the dominance of those mega cap names. Tom, do you see opportunities in something like energy? A lot of time people are skeptical about chasing something like this that's already run for a couple months. I would think of you as someone unafraid to chase something or really to follow a trend that's working. Do you, same question, would you follow something like energy that has been working, or is it more an opportunity to look at pullbacks in some of the technology leadership or growth stocks?
Yeah, I tend to stay away from energy just because the volatility of the group. I mean, they lead sometimes during bull markets, they lag sometimes. They lead sometimes during bear markets, they lag sometimes. So there's just no real positive correlation between energy and what the overall market's going to do. So if I'm bullish the market, I tend to stick with those aggressive areas that Julius was talking about. And when you had asked Mish earlier about, maybe what could change her thoughts about this bullish environment.
Yeah.
And, for me, it would be like discretionary taking a backseat to staples. And we're seeing the opposite of that right now. If we go back to 2021, right before we topped, before the cyclical bear market began, December of 2021, the XLY versus the XLP took a big, big hit, even though the S&P 500 went higher. We saw a lot of rotation away from the aggressive groups. And I believe in the month of December 2021, all four defensive groups had healthy leads over the other sectors in that month. So one warning sign that I tend to look for is the relationship between these sectors and what's performing well when we make these advances. This last move that we saw when we bottomed, the most recent low that we just saw, I think the S&P 500 hit 43.35.
Right.
That rebound since then, we've seen consumer discretionary outperform consumer staples by more than 8 percentage points. So I'm not seeing the Wall Street firms, I don't see the money rotating away from some of these areas that we should be seeing money rotate away from if all of these things we're hearing in the news are absolutely going to come true. I'm just not seeing it. So the story I listen to is always the one on the charts, not the one on CNBC, not the one on the various media outlets. I like to follow what's going on in the charts, and I'm just not seeing anything that really is telling me that this market is preparing for a big decline. So I recognize energy. I like energy. I like anytime a group is breaking out to new highs. I think that's always a bullish sign. But I tend to stick with the areas that I believe will sustain a move to the upside in a secular bull market phase. And so for me, that's going to be mostly technology, mostly consumer discretionary. But I do want to throw in a couple of groups that have lagged recently, industrials and financials. They love the fourth quarter. I think they are prepping to make a big move to the upside. I think it's the XLI that's been up 14 of the last 15 Novembers. And if you look at the history of when the XLI makes its money, it's in the fourth quarter. It's by far its best quarter of the year. And so I'm actually watching the market right now to see if we start to see that relative rotation back toward something like industrials and financials, because I think they could be stronger in the fourth quarter than you might think based on what we're seeing right now.
So many good points in there, and you'd mentioned the sort of what I call offense versus defense. Here's that chart with 2021. I mean, it was one of those. I feel like looking back, one of the clearest signals of a rotation, right? A change of character, which was that all of a sudden staples dramatically start to outperform. And this is as the S&P is making a new high at the end of 2021. Right. That ratio is turning lower. You're not getting that kind of rotation right now. Julius, we're going to come back to you in a minute because I want to talk a little bit more about defensive leadership, because you and I were chatting about that earlier. Mish, I'd love to bring you in talking about some of those sectors that have been, I don't want to say forgotten, but sectors that have not done particularly well. And I don't hear a lot of people talking about our industrials, financials, maybe even materials, sectors that, you may expect to do well in a bull phase, but we haven't seen that. Is there opportunity? Would you agree with that assessment in something like industrials here?
Well, if you just look at the Dow Jones Industrial, it's actually doing extraordinarily well, especially compared to the other indices right now. And you're looking at stocks like IBM near the highs and GE. Boeing had taken a bit of a correction, but it's coming back. So some of the industrial stocks doing well makes sense considering how much government spending we have had in order to try to rebuild our own infrastructure here, which of course is a plus and a minus, because we know in some level of deglobalization that in and of itself can be inflationary. And looking at also this whole idea towards this building up sector with industrials and manufacturing, and even looking at the retail sector, we have to talk about labor, which of course has been really strong. But the question is, can we actually get people to work in these industrial manufacturing sectors to keep them going? And I think that's another big question mark. Obviously, labor has really helped in that people are employed. And even though you're seeing headlines about consumer debt and mortgage rates being so high, people not buying homes, et cetera, there's always another side of those conversations. Mortgage rates are really high, but existing home sales have been almost non-existent, all new construction, which of course supports material. So it's such an interesting, delicate dance right now in the market. And I really believe at this point in materials, which of course will bring me to my biggest conversation we can have as the day goes on here about commodities and what that means for some of these raw materials, because nothing unless it's technology and AI and things that can be created from a computer, and even running those computers can be done without actual raw materials. And one of the reasons why we're seeing this big explosion in oil and energy is because of not only obviously production cutbacks, but real shortages. And we have that across the board in a few essential commodities right now.
Can you talk to us, Julius, when you're thinking of rotation, what about some of these cyclical sectors? And we talked about energy, what about materials and others that, again, I mean, thinking about opportunity and building of infrastructure, you would think there's a big opportunity for upside in the commodity space. Are you seeing any signs of that in your work looking at rotations at all?
Yeah, I look at asset class rotation on a regular basis. And for me, commodities are an asset class. I don't necessarily look at them, well, I do compare them to equities, but I see them as an asset class. So I usually bring up an RRG that holds a few asset classes, and you can definitely see the improvement of the commodities there as well. And if you look at the really long-term commodity charts, they have started bottoming. It's probably 2 years ago, and we had a really nice rally. And I told it in my show, Sector Spotlight, a couple of times that, this is really, the start of a long-term bottom, and then we started to come down. And my initial take was that is going to be the first setback, but that, I have to admit, dipped further than I expected. But it looks as if we're now back on track, and these commodities are picking up steam. So I'm totally agree that commodities are definitely an asset class to watch, especially if other things may go sour in the future. So these commodities are definitely something you should take into account. I got one more thing that I want to go back to, the seasonality question that you asked.
Please.
I do a lot of seasonality stuff in Sector Spotlight every month. At the end of the month, I look ahead. I try to look ahead what seasonality is doing for the coming month, and I want to see if there are any tails of sectors that are aligning. And it's interesting that people are saying, so it's the seasonal weakest part of the year. So September is the seasonal weakest part of the year. And I'm not sure whether I agree with that, because it depends a little bit on how far you go back. If you look back 5 years, so if you open up the seasonality tool on StockCharts and you leave it at the 5 years, then September is really weak. If you lengthen that period to 20 years, then it's like smack in the middle. It's not really that bad. And also, whether you acknowledge sell in May and go away, or what Tom is saying, it's not really May, it's July. But I think both phrases agree that it is remember to come back in September. So we're already halfway through the month, saying that, this is not the time to be bearish based on seasonality. I think this is the time to become more bullish on seasonality, because we're ending that doldrum period. We're ending that seasonal weak phase, and we're getting into probably the strongest phase of the year. And that's adding to all the other positive things that we've been discussing here.
Yeah, there are a number of good points. And what a lot of people don't forget, the full original quote, which originated in the UK, I think, was sell in May and go away, and don't return until St. Leger's Day or something. I forget. I don't know how to pronounce that, but it's like it's a horse race in the fall. And so the full quote is sell in May and then come back in the fall. But a lot of people kind of ignore that last part.
Yeah, it's Earth, Wind, and Fire month, right?
Yeah, September, right? Yeah.
Yeah.
There we go.
Remember.
So
no, I think we all know what we're talking about, and it's just it depends a little bit on how accurate I see seasonality as a guide, not necessarily as like a pinpoint thing. Sometimes we're a month off, a couple of weeks off, but it's it is pretty clear that we're getting out of that weaker seasonal pattern and getting into a stronger phase of the year.
Yeah. Tom, if I could bring you in when we're talking about interest rates a little bit. So I think a lot of people are, looking at two different sets of information. Growth stocks overall have been doing well. And I posted something on social media earlier today, which was, how bearish do I want to be when Alphabet looks like this? And just had a picture of Alphabet for the last year. I mean, it's going up. And how much do you want to fight that clear uptrend, right? But at the same time, if you look at the interest rate environment, where rates are at the highest levels we've seen in quite some time, it's more expensive to do anything involving borrowing money. It would seem to be a big headwind for some of these growth leadership stocks that have done very well. So as you're looking at the markets, how do you reconcile growth stocks with good setups versus an interest rate environment that would suggest that shouldn't be as good as it looks?
Well, that's a great question. Being a CPA and having actually done valuations in my past as a CPA, practicing CPA, I can tell you that rising interest rates, if we forget about everything else, rising interest rates will cause valuations to drop because those future earnings will be discounted back using higher rates, and they're going to be less. They're not going to be worth as much. But interest rates are not the only part of the equation. I mean, if you look at some of these growth stocks and how big a beat they've had in earnings, and some of the guidance that where we've seen raises, you can't just look at it from an interest rate perspective. You have to look at it from a growth perspective as well. And if the growth story is greater than the interest rate story, then these stocks will continue to rise. And I think that's part of what's happened. I think the other part of what's happened is a lot of times the stock market looks ahead. We've all heard buy on rumor, sell on news. And I think part of what's going on is I think the stock market is already way ahead of the Fed and says, okay, you can play around, you can pause, you can hike one more time if you want, whatever. We're getting close to the end of this rate hike cycle. And what we're looking ahead and what the market, I think, is pricing in is some significant future. Well, I'm not going to say significant. Let's see how things play out. But I do think it's going to be the end of rate hikes. I do think that there's going to be more pressure on the Fed if there's no inflation to actually begin to lower rates. And I think some of that is playing into the valuations of many of these growth stocks. Now, another really interesting part, I know Julius was talking, I feel like we're in like a presidential debate. Because I'm ready to go back and talk about what the person.
Let's just make it more civil, though, okay? A little more civil. That's all I'm asking for as your moderator, but go ahead.
Well, I mostly agree with everything that's being said. September is kind of a weird month. Now, I've looked at every single day on the S&P 500 since 1950, every day on the NASDAQ since 71, every day on the Russell 2000 since 87. I've got it all in an Excel spreadsheet. So I got a lot of data to go back on. September is a bad month historically. It's really bad the last 10 days of the month. And we're not there yet. And I'll read you annualized returns. This is on the NASDAQ. Annualized returns by day since 1971, starting with the 20th. Because the 17th, 16th through the 19th are pretty flat. The 20th, annualized returns by day on the NASDAQ. Minus 27%, the 21st minus 86%, the 22nd minus 64%, the 23rd minus 66%, the 24th minus 26%, the 25th minus 35%, the 26th minus 60%, the 27th minus 32%, 28th we get a pop of 53%, but then the 29th is minus 103%. And for anybody saying, how can you lose more than 100%? We're using annualized numbers.
Yeah.
So, but if you take that whole stretch from the 20th to the 30th, I mean, I've looked at a lot of periods in the market. There is no other 10 or 11 day period like this in the entire year. So we got inflation reports coming up. We got the Fed, and we've also got this period where I like to say dirty laundry. I think a lot of companies are getting rid of their dirty laundry at the end of September. Because if you notice, I follow a lot of earnings that come out throughout the year. And many companies will say, well, we fell short this quarter, but we really think next quarter we're going to bounce back. And for the year, oh my gosh, things are still really rosy. I think by the time you get to the end of the third quarter, folks are now no longer saying, hey, we're going to recover by the end of the year. It's next year. So I think the tendency is for a lot of companies to bury a lot of bad news when they come out with these fourth quarter or third quarter warnings, at the end of September. And so I think that plays a role in what happens at the end of September. I don't really have any other way to explain it, but I can tell you based on history, we are still staring at perhaps the worst 10-day period of the year as we look ahead toward the end of September.
That is your buying window then.
Yeah, I actually love buying into this weakness. And that's what I've been saying. And I've also been saying if the bears don't get control over these next few next week to 10 days, I'm not sure when they're going to, because once you step into the fourth quarter, that's when we tend to see some really bullish action. And one last comment I'll make on Apple, which I think is really interesting. Seasonally, if you go back and look at Apple relative to the S&P 500, you'll see that it is seasonally, it outperforms from January all the way through the end of August. September through the end of the year, it's just a normal stock behaving stock. It really doesn't like the fourth quarter of the year. So I think we'll see some of that rotation out of some of these stocks that have made big moves. And that's why I think we could see rotation into areas like industrials, financials, maybe even some healthcare, like healthcare providers.
Tom, you covered about 8 really meaty topics there in a couple minutes. That was awesome. But what I love, right, when I asked you about interest rates, what I love, and I don't know if you did this intentionally or not, but your initial thought was, if we forget about everything else, higher rates mean this for stocks. And I think that's an important reason why charts are so valuable. We so often love to make these simple comparisons. Higher rates mean this for growth stocks, but you have to remember there's a bunch of other things, right? This isn't a simple, combination of factors. There are so many different factors to think about. I think that was really well said how you laid it out that way. Mish, could I circle you in terms of some of the seasonal weakness here? Particularly, you implied, Tom, a relationship between multiple timeframes, right? The short-term weakness, but the long-term strength. Are you seeing a similar sort of setup, Mish, or anything you would see subtly different than how Tom described that here at the end of September?
I thought he did a very good job of explaining it, and especially the last 10 days of September, considering I heard something really interesting on CNBC, and that is Leo Cooperman. He was talking about the ratio between the CPI, the core CPI, and the Fed funds rate. And right now, at these levels, they actually are not concerning from an economic standpoint. And so let's talk about these last 10 days, right? So what could happen, of course, is a surprise to CPI to the upside, which of course would then force either the Fed to continue to raise another time or more, or worse, the Fed doesn't raise in essence and the core CPI goes up. Lots of talk about raising the target for inflation. And instead, we start to see some of the ratios flip, where a lot of retail investors right now are buying bonds and selling equities, anticipating some kind of a recession going forward. So that's kind of the step back. But there's one area we have not talked about yet, and one of my favorite places to look for a real gauge, and that is the Russell 2000 or the small caps or the S&P 600 if you prefer that. And essentially, every time I really want to get some kind of information about what my bias should be right now, equity-wise, I look at that and I realize that 1800 in the Russell 2000 was such a key area to break out of. And so far, we got up to 1900, maybe a little bit higher than that, but we have not broken down from that level. So to me, it's pretty simple. If we do, then yes, I would think that would drag everything down with it. Would also mean that this nice little relationship that Cooperman was talking about is going to start to deteriorate. And the reverse, if it holds and we can work our way back through 1900 again, then regardless of what the seasonality is, that tells you that there is some inherent strength in this market. And we can examine the reasons as we have already, but for whatever the reasons are, it's worthwhile following. So that's kind of, how I'm looking at everything right now in terms of September and the rates and what happens over the next few days, or at least the next 2 weeks or the end of two weeks of September.
Yeah, well said. And thanks for bringing up small caps, Mish. We're looking at the Russell 2000 ETF, and the range you're talking about kind of coincides with like 195 to 200 on the Russell 2000 ETF. Which is ticker IWM. And, Julius, when you're looking at this chart, we sort of had a peak in August, in February, in July, while the S&P and the NASDAQ have been going higher and higher. Small caps really not a part of the picture. How important, from your perspective, is a breakout in small caps to confirm this rosy picture that we may expect going forward?
It will be helpful, but I'm not sure whether it will be crucial. If we talk about the market, we usually talk about the S&P 500, and we all know that those are the large cap stocks. So when they continue to do well, then they will drive the market higher. So when small caps join the bandwagon, then all good. If they don't, as long as they don't go heavily down, I think it'll be okay. I mean, if you go to the RRG chart, there is a drop down that will show you growth and value. Size. So
Size, yep.
if you go to size, then you will see exactly what Mish just said: the S&P 500, 600, and 400, and that will show you how that interaction is going. And when large cap is inside that weakening quadrant and starting to pick up, we know that is usually a very strong rotational picture when you go from leading to weakening and then start to move back up. Because what that means is that they're already in an uptrend, in a relative uptrend. They went through a bit of a setback, and they're now starting a new leg in an already established relative uptrend. That's usually a very reliable move. And you can see how mid and small caps are inside improving, and they're rolling over. Yeah. So this image is pretty clearly showing the strength of large cap stocks over mid and small caps. So are small caps super important for the market, and then describe the market as the S&P 500 to go higher? Not really, but they could put a damper on the broader market stuff. I think that's the best way to explain it. By the way, the center of the chart, the benchmark, is the S&P 1500. So this is a closed universe. All of the stocks that are grouped in these three indices are in the benchmark as well.
No, great illustration there, showing really the spread between large and everything else. That's been a story certainly in 2023, and it's a familiar story we've seen in previous years, like 2021 as well. We're actually getting near the end of this discussion, which I'm kind of bummed about, because this is a lot of fun. You guys, you're bringing up some really, really valuable points. I'd love to ask quickly about cryptocurrencies, because Bitcoin is one of those things that has been kind of all over the place, testing resistance around 31,000, pulling back again to 25,000. Anyone have a strong feeling about what's next for this sort of newer asset class, and what the opportunities could be relative to others? Anyone compelled to take a shot?
I'll take a shot.
Yeah, please.
Yeah. Well, right now, another new announcement today that came out about Franklin. What the hell is his last name? Sorry. I can't even read my own handwriting here. I wrote it down so I wouldn't forget. He's a billionaire guy. Templeton. There you go. Franklin Templeton. Add him into the list now of firms or companies or individuals that are trying to get an ETF to give a mass adoption to Bitcoin. And so it's happening. I mean, there's stories all over. It hasn't happened yet. And also from a seasonality standpoint, Holden Milstein, our Cleveland Browns fan we were talking about before, Dave, is also our cryptocurrency expert. He's saying from a seasonality standpoint, he's expecting that once one of these ETFs, at least one of these, are adopted and able to trade, then from October on, we might start to see a really good bullish move in cryptocurrencies. So, and of course, even the altcoins will pretty much depend on what happens with Bitcoin. And all the bears are out. They're talking about the death cross and it's going down. But meanwhile, this mass adoption to me is the biggest story to keep an eye on. And actually, from a discretionary trading standpoint, we bought some Coinbase, because that will benefit greatly if any of these ETFs get approved.
Yeah, really good point. Julius, can I get you to comment briefly just on the technical configuration of Bitcoin and what you're seeing here currently? We're just bouncing off that 25,000 level here.
Yeah, it's undeniable. 25K is the level to watch on the downside, and then on the upside, it's a little bit more vague. I label it between 31.5 and 32.
Yeah.
Those are the crucial levels. And if you go to the really longer term picture, I am still in the bullish camp for Bitcoin. We had that massive top, we broke down, we rallied, and then we stalled around 31.5. A couple of times, established new support at 25K, which was previous resistance. So that is all respecting the technical levels very well. But I do feel that the time is running out. We now need to lift off this 25K area, push to 31 and higher to really extend that bullish move. If we don't do that in, let's say, the next quarter, then Bitcoin is probably going to be more sideways. If we drop below 25K, I'm not sure. That'll be very bad for Bitcoin. And if we, jump on the bandwagon with what Mish was just saying with the adoption of the ETFs, hasn't happened so far. There's a lot of stuff going on in the regulatory issues. There's a lot of trust issues with all these crypto-based companies that are falling over and fraud everywhere. I have been an institutional investor. If I was still running a portfolio, a multi-billion portfolio, I would be very reluctant to add a lot of money to the crypto space, just because of these issues. Yeah. And as long as that's not resolved, it'll be very difficult for crypto to become a mainstream asset class. Because remember, if you look at the assets under management for crypto right now, just throw it all in one pile, all the altcoins, Bitcoin, etc. It's a drop in the water. It doesn't mean anything compared to stock markets or even bond markets.
Yeah, that broader adoption is still a big hurdle. But if Mish's junior analyst, the Cleveland Browns fan, says it's a possibility, that's good enough for me. I think we should all know. In all honesty, a great illustration of the relationship between the chart and Mish. Some really important hurdles that I think, if they do start to happen, certainly you could see the upside potential. We're almost at the end here. I'd love to go a quick lightning round and just have a couple questions to pose to each of you. Give me like a 10-second answer at most, if you could. But I'd love to just leave our viewers with a couple items. I'm looking at you, Tom, as I'm saying that. But I want to make sure we just give our viewers a couple ideas of things to keep in mind here to set them up for success for the remainder of the year. So, Tom, to kick it off, what's the one chart besides like the S&P 500 that you should watch or that investors should watch for a good market tell here in the coming months?
I actually like the small caps. I like the IWM. I think we're going to see money rotating back. We already on an intraday basis. I do a user-defined index at StockCharts to track this, but I'm looking only at intraday data, the IWM versus the QQQ, and it's actually been rising since the beginning of June. So that's where I'm focused on the IWM right now. Well,
great point, Mish. How would you answer that question? One chart.
Well, I certainly agree with Tom, but I have to tell you one very funny story today is that a moose showed up in Santa Fe. So you had a moose with a backdrop of cactus. But why did the moose show up in Santa Fe? They don't live here. They don't ever come south of Colorado because obviously we are having some real stress to them finding food. And so to me, the one area that I'm really watching very carefully, besides the small caps, would also be DBA, which is the ETF that encompasses a lot of soft commodities, most soft commodities. That is still sitting here around 22. And if it continues to go up from here, I think it can explode. And of course, that can upset the apple cart, like our poor moose now looking for something green to eat in the desert.
Well said. The agriculture ETF, DBA. Julius, what would you say? One chart to watch for a good market tell here in the coming months?
Weekly RRG of the sectors. I'll make up for the extra time that Mish and Tom just took.
And I was saying, thanks for the moose story. I don't want to say this publicly too much, but we did have a bear break into our backyard about a week ago and cause havoc around our trash cans. I don't want to read too much into that a bear was in the Keller's backyard, but I don't think that's a bullish signal. I don't know, but it certainly wasn't bullish for the cleanup crew at the Keller household. Next question, if we could keep this rotation. Next question, what do you think will be the strongest sector between now and year end? Tom, what do you think?
Industrials.
Industrials. All right, Mish?
I have to go with Tom. I think industrials, but I also think commodities.
Okay. Julius?
Communication services, driven by Alphabet and Meta.
XLC. All right, little growth, little cyclical. I'll take it. The opposite. What do you think will be the weakest sector, a sector to be avoiding here between now and year end? Tom?
I would just stay away from the defensive groups. They've been underperforming. I don't like them in what I believe is a secular bull market. So I would stay away from all the defensive groups. Maybe a little healthcare you could sprinkle in. I like healthcare providers, but other than that, I'd be careful.
Mish?
I would probably say at this point, maybe looking outside of the United States, China would be one to avoid. Within the United States, I probably would want to still avoid anything to do with the financials at this point. I think they've really struggled, and I don't know if we've necessarily seen the worst of all of that.
Still a lot to prove there. Julius?
Utilities. Really weak rotation on the RRG and actually also breaking down on the price chart.
Yeah, I'm glad you mentioned, Julius, you and I were talking earlier, and Tom, you echoed that as well. One thing we have not seen are defensive sectors doing well. I would throw that in as one of the great market indicators. Until those things do better, things are just not getting that bad. Final question, and then we are done. Tom, if you could own just one ETF besides the S&P and the NASDAQ between now and year end, what would it be?
Well, I own the IWM and I own the XLI, so I'll give you two.
A 50-50 split, we'll call it, between those two. Okay, Mish?
Well, we also own IWM, and for me also, again, outside this country, since we've only talked US, is Vietnam. It's been my big sleeper trade all year, and it looks like it's about to explode even higher.
It's when you think outside the U.S., a lot of possibilities could be emerging. Good to pay attention to the charts there. Julius, one ETF, what would it be?
SSO.
SSO, tell me more. The
That's
ultra
cheating.
leveraged S&P.
That's cheating.
I was going to say
That was a joke.
Come
So
on, in my
have,
head, I'm like, I think that's a lever. Yeah, of course it is. Okay.
I have a backup plan. This was a joke. So the backup plan is UUP. The dollar
bullish dollar ETF. Okay, I will accept that answer. Fair enough. Listen, you guys, this was a lot of fun, and we touched on so many topics. I feel like people got a little window into so many different themes to pay attention to, but you guys all really well hit on, I think, some of the challenges facing investors, all the different data points, but each of you in some way or another reminded us to focus on the charts and focus on the evidence that the market provides back in the form of price action. So thank you guys so much. Tom Bowley, Chief Market Strategist at Earnings Beats from South Carolina. Mish Schneider, Chief Strategist at MarketGauge from Santa Fe, New Mexico. Julius de Kempenaer, founder of RRG Research, not from Amsterdam, but from Redmond, Washington today. Thank all three of you. Thank you so much for joining us on Charting Forward this time around.
Thanks, Dave.
Thanks,
Thank you,
Dave.
man.
I'm Dave Keller, the Chief Market Strategist here at StockCharts.com. Thank you so much for joining us for our latest edition of Charting Forward. Don't forget to check out some of our previous episodes. This is a great opportunity to hear from some of the great minds in market analysis and technical analysis giving their take on what may be next. Have a great one. We'll see you next time.